From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, April the 14th, and welcome to another episode of the Macrocast. I'm your host, Ylan Mui, a managing director here at Penta, and I'm joined today, as we are every episode, by Brendan Walsh and John Fagan from Markets Policy Partners. Hey, guys.
Hi, Ylan.
Good morning. Well, we have got a packed episode today, and I have to admit that we have been on a little bit of a roller coaster when it comes to where we are in the economy. There was some bad news this week out of the Fed when it looked like their staff is now predicting a recession by the end of this year, but we're getting some good news out of the banks where earnings are rocking and rolling. So hopefully you guys can help us make sense of all of this confusing and conflicting information. So let's get started by talking about the Fed, because all roads start there. All roads lead to the Fed. And there was a document from the Fed that came out this week that showed that staff economists there are now predicting that there will be a mild recession sometime later this year, followed by a recovery over the next 2 years. But this really seemed to be the first time that the Fed is acknowledging what the markets have been saying for a long time, which is that the economy is going to start to slow down this year. So why do you guys think the Fed is finally having this come to Jesus moment?
Yeah, it was definitely very interesting because, the Fed writes the minute. They don't have to include exactly what they said in it, but they felt the need to let, investors know, and the general public, not just investors, that the staff is now forecasting a mild recession. But part of that had to do with the meeting was very in the middle of our mini banking crisis. That has obviously faded a lot. We'll get into it later, but a bunch of the big banks reported, and they're doing quite fine. It would probably be more interesting when we see the regional banks how they report later next week and into the coming weeks. But the Fed still, is telling us from the March meeting minutes that they think that there's a possibility of a recession, and also that decision to raise 25 basis points was a hard one. It really, they didn't know what they were going to do until they walked in the meeting. Subsequently, we've heard a lot of the usual voices still speaking very hawkish and the need to continue tightening rates. But we have a new member at the Chicago Fed, an old voice from the Obama administration, Austin Goolsbee, who is now the head of the Chicago Fed, and he just happens to be a voting member. And his kind of first speech was much more balanced and called for caution. And Mary Daly out in San Francisco also kind of echoed him. So there are some new voices, and it's important. Austin's a new voice, but he's very well respected in monetary policy circles. That there's a lot going on out there. The data is very much weakening, and if we might not want to pay just solely into all of our attention on the CPI component, which really in the end is an incredibly backward-looking read, because we get it a month after it happened, and also a lot of the way that it's computed, especially with the housing component, that's like what happened 6 months ago.
Despite those good numbers, we had Governor Waller out this morning talking about how inflation was still way too high, and that it wouldn't necessarily be just one more rate hike; it could be even further. And this is, the juxtaposition of the staff forecasting a recession, and even the more dovish members of the committee not really talking about. It's more on the table is whether we pause or what kind of pace we go at.
That's an important point, John.
Cuts are never part of what they're talking about.
Yeah.
But that's exactly where the market is. And so we've talked about this massive disconnect between, the expectations the market believes, yes, we are going into a recession later this year, and the Fed is going to be responding to that, as they almost always do, with rate cuts. And the Federal Reserve members and board members have been absolutely unanimous in saying, look, rate cuts are just not in the picture with inflation where it is.
I think the phrase from Austin Goolsbee, the Chicago Fed president, was prudence and patience. And that word patience in particular feels to me like, the kind of code word Fed speak for holding rates steady for an extended period of time. But we'll see where that lays out. But, the fact that the Fed seems to be late to the game in accepting the possibility of a recession, the Fed is essentially following the markets, makes me wonder whether the Fed is going to have to follow the markets again in actually cutting rates if they're going to continue to hike so much that the recession might be even stronger than it would be otherwise. They're almost going to, by default, make the market's expectations come true, because then they're going to have to cut rates even more dramatically in order to make up for it, don't you think?
Yeah, and that's the danger of what they're doing. They're losing their credibility by over tightening. The best thing they could actually do, they're so worried that they've lost their credibility on inflation and that they have to keep hiking to make people think that they're inflation fighters, that they're ignoring all the data. So the retail sales came out today. It was down 1% in March. We get caught up in surveys and manufacturing, blah blah. In the end, all our economy is we're a consumer economy, and it's over 2/3 of what we do. It's down 1%, and everyone's kind of ignoring that. Waller's out here saying we need to keep tightening. Retail sales are down because you've already over tightened.
But Brendan, how much of the decline in retail sales is because prices are coming down? So people are spending less because the things they need to purchase cost less. Is that a factor at all?
It definitely was with gasoline. Gasoline come down, but also food prices have stabilized. That's another obviously big contributor. But in the discretionary spending, those were also down. So it was kind of weak across the board. And also it was well below consensus. And obviously when the economists make their guesses at what it can be, they were aware that food prices and gasoline prices have come down. So it was even worse. They had thought it would be down a few tenths, and it was down a full percent. That's a big deal. And we got the PPI, so the producer price index, which obviously leads into what ends up we at the counter end up paying. But that was again negative, and for the 8th straight month, it's been below what consensus expectations are. We also today got the import and export price component for March. Import prices have been negative for the last 4 months. So there's a huge amount of all the pipeline of inflation that will end up in the CPI has been very weak for all year, all of 2023. But the Fed is just kind of looking at the CPI component, which also housing plays a huge role in it. The CPI was only up because the shelter component, and that's the 6-month rolling average. So we're literally looking at what the housing market looked like 6 months ago. We know that the housing market is very weak and house prices are dropping. So if you actually update it, it's not that difficult to do. You just put in the Zillow estimate for the shelter component. We would have had negative both headline and core for the last couple of months. So I just worry that the Fed is making a terrible, terrible policy mistake, and their credibility is going to be called into question because they're making policy based to try to defend their credibility.
How long does it typically take for changes in the producer price index to feed into the consumer price index? Is there a lag?
It's usually a couple months. A couple months lag.
Okay.
Yes.
So normally we would look at this and say, just on the face of it, great, prices are coming down. That's exactly what we want to see as consumers. But the problem here is that prices are coming down, but the Fed is still, at least for now, on a path to continue hiking rates. And that impact of those rate hikes, we're not going to see for another few months as well feed through into the economy.
Yeah. No, it should be mentioned. The most hawkish people that have spoken this week are not voting members on the FOMC for the upcoming meeting in what month? We're in May. So in May,
early May.
Yeah, it really is. Thinking back and thinking about the difficulty of the Fed's job here, as Brendan was saying, there are a lot of signs that inflation is coming lower, but the counterpoint to that is, but look where it is. It's still really high. It's nowhere near the 2% goal. And, even if the forecast and extrapolate, the Fed hasn't changed those very much. It certainly hasn't, marked up its estimated timeline for when it's going to get inflation back. And it certainly hasn't proven squishy on this 2% goal like a lot of analysts kind of expected. We've seen the Fed kind of move through, subtly move the goalposts on some of these targets. It's a 2% range over particular blah, 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 blah. They don't talk about their target like that. They talk about their target like 2% as a ceiling.
Yeah, exactly.
And I think that some of that's communications. Obviously, they want to sound real tough on inflation. But we also saw, we talked about this in an earlier Macrocast, OPEC Plus coming in and cutting supply and into a market that the IEA came out with their monthly report and said, these cuts are coming into a market that was, going to be challenged by its balance, by the supply demand balance later this year with potential undersupply. And this just makes it even worse. We haven't seen oil prices skyrocket here, but they're back on the ups, a sort of knocking on the door of multi-month highs. And, the potential for breakout is where a lot of analysts are. That would complicate the Fed's job in the second half of this year if oil prices go back to the high side. But at the very least, they're proving sticky with OPEC support underneath them. It's a really challenging time. And thinking about a recession in this context, when's the last time we had a recession that wasn't immediately met by Fed easing or, fiscal stimulus or both, right?
Both.
And we could be going into a recession where we get neither, which is kind of unimaginable. And,
no, it's a good point on the fiscal side, because, George W. had a huge tax cut, which, it did stimulate the economy. It obviously wasn't great on our deficit. And then after 2008, we spent a lot of money, trying to get out of that. So, but we haven't had a recession since. And then after the great recession in 2008, the Fed went bonkers and did steroids QE and kept, rates basically at zero for over a decade. And we're just looking at a very different world. But here we had the IMF-World Bank meetings, and they put out their projections, and they're warning of a recession, not just in the United States, but globally.
Yeah, it's kind of interesting. During COVID, we had both fiscal and monetary policy rowing in the same direction, potentially too hard. And now, if we enter another recession, we might have fiscal and monetary policy still rowing in the same direction, but in the wrong direction potentially in order to safeguard the economy. So everything that you hear in DC is about, spending cuts, ways to constrain spending, ways to bring down the deficit. You don't hear much about ways to continue to spend more money. So the fiscal stimulus piece is likely not.
Well, now might be a good time to talk about it. But Speaker McCarthy, is it today he's up on Wall Street, or is it next week? He's doing his best to try to scare. Yeah, maybe give us a background on what he's doing on there.
Yeah, so I mean, this is sort of all related here, right? Because at one sense, you say that, or investors are anticipating, policymakers now too, the recession at the second half of this year. But the wild card in all of this is going to be what happens with the debt ceiling. Republicans are now putting out their, I guess, sort of first pass at what they want to see in order to negotiate on the debt ceiling. That would include constraining spending at FY22 levels. And including a bunch of strings on that, including returning unused COVID funds, right, back to the federal government that are just not going to go anywhere with Democrats. I mean, even constraining spending is not going to go anywhere with Democrats. But you add in all the strings, and it's simply a non-starter. So McCarthy's plan is to speak directly to Wall Street on Monday and lay out his plan for what Republicans want in exchange for raising the debt limit. And I'm not sure if the speech is intended to try to reassure the markets or if it's intended to try to spook the markets. And I'm not sure which one he actually wants, right? Which one is going to serve his purposes better.
Can you remember a speaker, or really any, congressman of significance going actually up to Wall Street to give a speech?
Yeah, I mean, as a policymaker, you always want financial markets. Financial markets have the ability to thwart or, support your policy goals. And as a policymaker, you want price action in the relevant markets to be a wind at your back. And so, we heard when I was at the Treasury Department, I mentioned this before, we during a previous not as scary debt ceiling fight, there was some questions from the Democratic side. Why isn't Wall Street freaking out about this? This is during the Obama administration, and the subtext was, it would be helpful for us if the markets were more concerned about this, because it would focus minds from the Republican side. I think Speaker McCarthy is trying to essentially accomplish that kind of approach, where he gets markets focused on these risks, and if there is additional volatility around this, in Treasury markets and other risk assets and U.S. stock markets and so forth, that would, in his estimation, and I agree with that, to put additional pressure on the White House to try to, to come to a compromise. But it's, as you say, Ylan, the common ground here is not particularly expansive. It's maybe non-existent.
Yeah, that's the most important point. Hopefully, we don't actually default on our debt, but I can guarantee you we're not having expansionary fiscal policy anytime soon.
Yeah, Brandon, you brought up the good point that in the immediate term, maybe markets are a little concerned that there could be a blip, but in the long term, markets seem pretty confident that this will get figured out. Yeah,
the part of the Treasury curve that's actually priced a couple months in advance when actually we could have a technical default, that is showing a little sign of concern. But everything beyond it, the 10-year is not trading off of concerns about us defaulting on our debt.
Yeah, equity markets aren't either. You see it in the credit default swaps on U.S. Treasury debt, which is, an esoteric instrument, essentially the cost of insuring against default. And what else are you gonna buy, right, to try to hedge this risk? And so, that's not a particularly, as I understand, a particularly liquid contract. But so you want to take the price action there with a grain of salt, but elevated levels on that metric. But again, to your point, these esoteric, little red lights flashing on the dashboard, but it's hardly, it's hardly infected other, broad asset classes yet.
The interesting one for the Fed, especially on their credibility, is the timing. So their meeting is a couple of days before we'll get the non-farm payroll report. And the NFI, so the small business, the NFIB has a survey of what small business are thinking, and really that's been the driver of job growth for the last year. It's been all small businesses, and the hiring intentions fell off a cliff in their last one. So there's a very good chance that the Fed could raise 25 basis points and then 2 days later have a completely different view of the world. That the labor market's a lot weaker than they thought.
As they say, they are data dependent. So we'll find out what the data actually says when it comes out. But this is a good time to take a quick break. And when we get back, we'll talk about the global economic outlook and why some other central banks are starting to hit the brakes. You're listening to the Macrocast.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at pentagrp, or find us on LinkedIn at Penta Group.
Welcome back to the Macrocast. We've been talking about the possibility of a recession later on this year, but there has also been at least a little bit of good news. Some of the biggest banks in the country released earnings recently, and they looked pretty good. Many of them beating expectations, seeing some significant growth in profits. So, John and Brendan, what do you make of this bright spot.
Yes, so obviously we always pay a lot of attention to the bank earnings, especially because that starts the quarterly earnings season, and JP Morgan's always the first. Their CEO, Jamie Dimon's, a really kind of fun guy. He speaks his mind and he offers a lot of insight. So a lot of attention gets paid to that. JP Morgan had amazing earnings, beating even fairly high expectations. But also Wells Fargo came in strong. They've been a bit of the basket case of the big kind of 4 or 5 banks. Citi also did really well. And two things are kind of being seen. The big banks, they were kind of beneficiaries of this little banking crisis, because in the end, the banking crisis was around, your worries about deposits, and all of that kind of flowed into the big 4 banks because they're SIFIs and so regulated. We kind of know that even if they were terribly managed, that the federal government would not, they're not allowed to fail. It's called too big to fail. But more importantly, on the credit side, they're not seeing deterioration in any of their loan books, even commercial real estate, which is a very good sign. The PNC, which is a very, very big regional bank, but it's below those big 4. They did fine, but they kind of missed on earnings. So I think this earnings season's going to be much more interesting to see how the smaller regional banks are faring. And it's also, I think, somewhat enlightening that this was a crisis that could have been avoided. It wasn't that Silicon Valley made bad loans. It was that they were just very poorly managed, and they didn't know how to. They were started in a time of very low rates where they never had to fight for deposits, and also they never had to worry about Treasury yields going up, and they just completely botched it. Similar to First Republic, they didn't necessarily do anything wrong, but their business model was to make you a very good, make rich people a very good mortgage, and then try to get the rest of the business. So they just had a ton of really low yielding mortgages on their books. Which obviously was not great for their earnings. So I think overall, it's a good sign that we're not in the midst of a huge banking crisis, and hopefully it doesn't have to be the big drag on earnings that the Fed staff thought, not on earnings, but on growth and loan growth that the Fed staff thought it was going to be 3 weeks ago.
Yeah, amid these big, Wells Fargo and JP Morgan announcements, there were, some hints of caution, built up beefier reserves. Yep. I think Jamie Dimon indicated that they've boosted their reserves by like 1.1 billion or something like that. Wells Fargo boosted theirs by 643 million. And, flagged the real estate book, particularly commercial real estate, but also auto loans, and credit card in the case of Wells Fargo, and Jamie Dimon said that there were storm clouds on the horizon, despite the sunshiny kind of results that they got in the first quarter, which, as Brendan said, were stellar. So there were those hints of caution down the road, and it's a good thing that the banks are preparing for these eventualities or potential issues down the road. So in terms of system stability, obviously that's a good thing. But fortunately for these banks, everything else looked so good that it hadn't really weighed on their share price in the overall response.
Yeah, certainly seems like the results give us confidence in the stability of the banking sector, though. Yep. Even though the banks did not see any deterioration in credit conditions, it does seem like that they acknowledge there would be some tightening of lending standards, which could have a ripple effect through the economy, could result in less credit being available for consumers. So to the degree that acts as another weight on growth for the second half, I guess that's where those storm clouds might be brewing.
Fully agree. Yep.
Yep, and that dovetails with what the Fed staff apparently is predicting, and is aligned with a lot of the other economists that are not ringing a warning bell. I don't think that, I think that the consensus is that this is going to be a relatively mild recession. Obviously, the Fed is going to have to say that it's a mild recession. A major, grinding recession implies policy failure, and the Fed cannot assume
they choose
policy
their words
failure
carefully
in its projections. So, but the general sense among the consensus among economists who are looking for a recession is a relatively shallow, but perhaps, somewhat longer recession with a weak recovery. And, again, that's a different kind of recession than the shock induced declines that we had around global financial crisis and COVID, obviously, which is just a completely different dynamic.
Sure. And the U.S. is not the only country, of course, that is facing some of these cross currents. This is happening in advanced economies and even some emerging economies across the world. The IMF and World Bank had their spring meetings in Washington over the past week. During these meetings, they released a forecast for global growth. And it shows that growth around the world is going to be slowing down this year. They brought down their forecast to 2.7% growth for 2023. That's a dip from 3.2% last year. They say this is, the weakest forecast they've had outside of a actual recession since 2001. So, Brendan, I know that you were meeting with lots of clients around the IMF World Bank gathering. What was the vibe? Did they feel like the U.S. was an outlier here, or did they feel like other economies are going to be facing the same challenges?
It's always fun to go to these meetings because obviously the big global growth and how U.S., China, and Europe is a big topic, but every country in the world is kind of under the auspices of the IMF and World Bank. So you can kind of really dig into some, small countries, like in West Africa, we talked about Sri Lanka, that really have issues going on that don't have everything to do with just global growth. So there's a lot of concern that policymakers are over tightening and that we're going to have a recession in the developed world, but also that could be very in the developing world that it won't be a mild recession, that it'll cause a lot of pain there.
We talked a lot about spillover effects from the Fed's actions during the global financial crisis. Maybe this is getting a little too wonky here, but is there a concern about sovereign debt as the world continues to raise rates?
Definitely, and actually, a lot of the talk is on kind of reforming the way that we do the restructuring with the IMF, and China's been kind of the sand in the gears there. China, I think it's kind of just a policy cultural. They refuse to kind of take haircuts on any of their loans, and China is kind of the biggest lender to a lot of the smaller countries. So there's a lot of kind of efforts on the rest of the developed world to put pressure on China to allow for more for restructuring programs that could actually help these developing worlds. But China kind of always refuses to take a haircut on their debt. I don't know. Was that the case when you were at Treasury, John?
Well, it just wasn't the same situation. China was getting into, when I was there, China was really kind of getting into the Belt and Road lending game, right? And so it wasn't clear. It was,
how they would handle a default. Yeah.
It was that really hadn't come up to the same extent, and there was a sense that Belt and Road. The U.S. saw it as a challenge, obviously, but, it wasn't necessarily seen as a, net negative for the countries that were recipients, because some of those projects obviously were needed. But there was always questions about the way that China operates, the project themselves, bringing in a lot of Chinese labor into particular countries, having a relatively thinly veiled geostrategic motivation for a lot of these projects, and basically fueling. They don't have the same sort of Foreign Corrupt Practices Act, and no qualms, has reportedly about the kind of corruption that can get your project approved in an expedited fashion in some of these markets, obviously, and they're far, the human rights concerns and democracy are like the furthest things from their minds when they're making these decisions. So, it was something that the U.S. kind of looked at with, U.S. policymakers looked at with a very skeptical and sort of into a lens of sort of China's less than perfect record of global citizenry, so to speak, and some very naked self-interest, up front and center in a lot of these projects. And that's playing through when it comes to debt restructuring and workouts as well.
Yeah, this checkbook diplomacy from China is certainly not all it was cracked up to be, or maybe not all that they sold it to be at the time. So we are almost out of time for this episode of the Macrocast, but I want to check in and see what's on tap for the week ahead.
So next week we have the global PMIs, which will be interesting, both services and manufacturing. But it's a bit of a more quiet week. We always get the jobs number, and then after that we get inflation and we get retail sales. So next week should be a little less of a market moving week on the data front.
Yeah, we have like the Fed beige book, which doesn't usually set the world on fire.
Purposefully beige.
Earnings.
Having covered many beige books, I can tell you, we struggle to find the news.
Yeah, exactly. You need a microscope, but. Anyway, but earnings season is going to be dominating headlines. We've got the big banks coming in, plus we have Netflix and Tesla and some other household names that are going to be reporting. So that will certainly be making news.
Great. And of course, Congress will be back in session, so we'll look for any developments on the debt limit. But thank you guys so much for joining us. And thank you to our listeners for tuning into the Macrocast. Again, I'm Ylan Mui with Penta, and you were listening to John and Brendan from Markets Policy Partners. Please remember to like and subscribe to the Penta podcast channel wherever you listen to your podcast. Have a great day, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.